I think we have everybody in, so welcome to our seminar today, which we'll be going through sort of the various different parts of UK property investments, why people are investing at the moment, what areas we would avoid investing in at the moment, what areas are very good to invest in, whether today is a good time to invest, and then how you look at the fundamentals of property markets to make your own decisions as well, rather than just having to listen to people like us. How do you go about and cross-reference the information that we give you, and also go and find some areas yourself. So we're going to go through that. That's a lot of information to go through, so a lot of it we'll be going through quite quickly. We can't go into huge amounts of detail as you'd expect on those. Obviously, as most of you know, feel free to get in contact with us. My email address is mark@baroncabot.com. You can get in contact with us at any time with any questions, and also please do ask any questions on the question function on this seminar. So anything you want us to cover over at the end, let me know. So as you know, or as many of you know, my name is Mark Pearson. I'm one of the directors here at Baron & Cabot. My background has always been property. I trained as a surveyor. Trained through my member of the Royal Institute of Chartered Surveyors in the UK, before I got into brokering property, which is a lot more interesting than being a surveyor, and now work with clients globally, both private investors and also advise the likes of funds and professional investors as well. So we're hired to advise as in funds, private wealth, and those sorts of markets, as well as private individuals. So I'm very well placed to be able to, both through my track record of investments, whereby we've been making clients well above market average for many years now in terms of our property investments, by just focusing on the fundamentals of property investments, not trying to sort of invent the wheel, so to speak. We're just using the investment strategies that have always worked and will always continue to work, by being sensible with the places we invest in, by being sensible with what we expect as a return in year 1 and 2, and being able to target the right areas. So most of what we'll learn today, or most of what we'll go through today, is not anything specifically, there's not some newfangled ways to do things. Our work is less about making new strategies. The strategy's always been the same. It's working on the fundamentals of property markets and where should be growing and what gives us the best chance of return. The hard work is actually having the resource to do all the research to find which areas are doing the strategy that has always worked for people. And so that's really what we'll go through, where I can raise a couple of these places, a few places that we've been working on and have worked very well for us over the last couple of years, a few places that we're looking at now which are about to go really big. So just to give you a little bit of background about why the data or our resources are good. As many of you know, we introduced a 112-point due diligence checklist. So just on property itself, and actually every property we work with has gone through a full due diligence report, full checklist, which is much more in detail than anybody would get buying their own private property. So just at a very basic level, we are protecting people from losing money or buying properties that aren't great, to be perfectly honest with you. And then secondary to that is our data and analysis team. So we have a team of people who are, their full-time job is using big data analysis machines. We worked a little bit with University College London at the start, and since then I've brought on our own staff over a year and a half ago now, and all they're doing is looking for parts of the UK where whereby using traditional methods of growth expectations in rent and property growth, we're able to see what areas of the UK match the fundamentals or continue to match the fundamentals for investment. So whether that's a city that's been performing very well for many years, 15, 20 years, But now we're starting to see maybe affordability is reducing. Maybe the properties are getting a little bit too expensive compared to the wages. So we're expecting drops. Other cities or towns, or even just very, very small postcode areas where we're seeing growth or expecting growth because their actual salaries are increasing. Maybe there's a new transport link which is bringing a lot of new industry there, people working, being able to live there and work in areas that are giving them a higher salary than that area itself was doing before. So we're going to explore a lot of these through this seminar. We were due to be joined by James, one of the heads here at Barron & Cabot, head of sales. But unfortunately, or fortunately for him, he got a last-minute opportunity to go to Portugal to follow his football team. So you'll just be with me today, and I'll be going through this, answering any questions that you have at the end, and hopefully you enjoy the presentation. So the first thing that we need to look at is, why has the UK always been really a place for investment for both international and within the UK? Why is property in the UK an investment over and above, say, bonds or equities, Bitcoin? There's various reasons why people put the majority of their portfolio into property, and then what's left, then they'll use more high-risk strategies. So the first thing with property, and specifically with UK property, really, because property is different all around the world, and actually all through the UK it's very different, but there's some fundamentals that we look at with property investment. So the first thing that we should ever do when we look at a market, and we don't just work in UK markets, although it is our favourite, we do work in international markets as well, but the first thing that we need to look at is the fundamentals of property investment. So they are really supply and demand, access to money, and affordability. So when we look at these, supply and demand in the UK, ever since the privatisation of property, and really through Thatcher in the 80s, ever since then, there's been an undersupply of property into the market. So most cities that you look at in the UK have a massive undersupply of property. There's some cities in the UK whereby there's been a large delivery of property this year, and so we sit out of it for a year or two because the rents just for over 1 or 2 years will be a little bit stagnant. They won't grow too much. But even with these cities where they've had a lot of delivery now, there's not enough delivery historically or ongoing for it to be able to plug the demand that's there. I mean, just at a very, very basic level, there's 250,000 new people in England each year. Cities like Birmingham are seeing 15,000 new people arrive and 1,000 properties delivered. It's an unsustainable model if you were looking to plug the demand. But in actual fact, we never have. And what that does is, one of the factors of that, along with just purely planning permission and the sort of the way that the UK government protects greenbelt land. In the UK, we have these small, dense cities, and when there's not an awful lot of land to compete on, when you have these ring roads around cities that everyone tries to live within, what happens then is you find that there's a drive on, or an upward pressure on property prices. But that upward pressure on property prices can only take place if there's mortgages available. So that's a sort of a global, certainly a national phenomenon, that UK mortgages are cheap, they're easy to get. No matter where you are in the world, you can get a mortgage for a property in the UK, and a lot of people, certainly our international clients, are unaware that you're able to, doesn't matter where you're from, you can get a mortgage for a property in the UK because banks also believe in the UK property market. So access to lending's there. So long as there's an undersupply of property, the pressure increases, and there's been an undersupply since the 80s. And then on top of that, we look at salaries, so wages. And if wages are increasing, then property prices are able to increase. If the UK continues to be performing like it does with an undersupply, international money is always being brought into the UK. And so these are the other factors we look at. Our primary factor is looking at the local market. So when we look at a postcode or a town or a city, we want to see that local market have a diverse employment type. So, we're not reliant on one employment type. You look at Aberdeen as an example, whereby it's a very oil-driven economy. Therefore, when oil prices are down, property prices are down. When oil prices are up, property prices are up. We like to look at towns and cities that have a diverse employment type, and then, as well as that, increasing salaries. Now, if you look at somewhere like West London, West London has some of the highest salaries in the UK and some of the highest salaries in the world, but unless those salaries are increasing at a faster rate than property, then the property market won't increase, or it certainly won't increase substantially. So we really need to be focusing on areas of the UK whereby that property, that average price is increasing, and it's increasing at a higher amount each year, rather than just sort of level, because that'll just mean that the property price will increase at a level. But if we look at property compared to just as an overall, we'll go into the details of individual towns later on. If we look at property overall in the UK and compare that with, say, property in other countries where there is oversupplies, whereby there's not consistency in mortgages, where there's massive inflation. So a lot of countries are seeing huge inflation off the back of the COVID-19, the pandemic. It needs to be paid for, and countries that certainly can't stimulate their economy are seeing massive inflation. Even you look at the likes of America and the inflation they're having at the moment. This makes the UK more and more appealing, because ultimately, if you've got inflation, money in your bank is worthless. It's less than worthless. It's actually losing money. And so you have to invest in something. So your opportunities are bonds. And bonds have normally been quite a safe investment, but at the moment bonds look a really terrible option. You've got equities, either through a fund or through just dealing in the stock market yourself. If you have the confidence in that's great. A lot of our investors do that as a sort of a smaller proportion of their portfolio. But again, equities are seen as much more risky. And you've got Bitcoin and cryptocurrency, which huge returns, thousands of percents, but also huge losses, and including my own personal venture into crypto sort of a few weeks ago. After not really being interested in it for a long time, I picked the absolutely wrong time to buy in, and I think I'm down 40% at the moment. Thankfully, it was just small amounts of savings that aren't that I can leave for a while. So, but these are the types of things that you can invest in. Then you can look at property markets elsewhere. So rather than the UK, we can look at Germany, which is a great market. We can look at, but Germany has rental caps that they bring in. Their government has certain rental caps in different areas. We can look at like Portugal, but then Portugal's slightly overpriced due to the golden visa situation. You can look at the likes of France, which has great mortgages, long-term, low-price mortgages, but there's a lot of inflation, and we can go through that in terms of price increase against inflation, so it doesn't perform quite as well. So US obviously has a market, but a little bit tricky at the moment to be investing in the US with the inflation and the sort of the various elements that are going on within government there. Australia, New Zealand, which has a similar market, just almost slightly ahead of the UK, but hugely expensive to buy into. So there's and obviously out in Asia, there's various very interesting opportunities. South Africa, but again, a lot of Africa at the moment has massive inflation. So really, out of all the different investment types, property is always very strong. When we can mortgage property as well, if you have £50,000 that you can put into a bond, you get £50,000 worth of a bond. Put £50,000 into property, you can leverage it with a mortgage and triple that investment level at very, very low cost. So property is a very, very interesting one. It's really the one that vast majority of the best or smartest or most successful investors have the highest proportion of, and I think we all know the stats of the highest proportion of millionaires have made their money from property. So because it's consistent, it's fairly easy to predict. So that's why people are investing in property. It's the fundamentals, predominantly the fundamentals within the UK market, and these are things that you should always be looking at. How do we look at those fundamentals? So very briefly, if you want to go and look at those, just reach out to me and ask for that information, or one of my colleagues. There's a lot of resources online, so there's huge amounts of, the beauty of the UK market is all of these resources are online. If you want to know what the growth of, we look at affordability as gross disposable household income. If you want to know what that is in the UK, then there's parts of there's government resources, Office of National Statistics, where you can get that. But ask us how you do that as well, because you can deal with that information incorrectly, create bad data. So you want to know what prices have been, what growth has been. You can find it. You want to find the inflation, interbank exchange rates, all these sorts of things that affect property prices. We're studying 24 hours a day. And when I say 24/7, it's because we have these big machines that even when we don't have staff working, when everyone else is asleep, these machines are still running the numbers, still looking at the areas of the UK. So ask us for it. There's resources for all of that. But importantly, you've come here not to go and do your own work, but to be given our own research. And let's start to look at some of the areas of the UK that are very, very interesting. So again, when you look at the way that we work, we're always looking for a trend. So what that means is we're not gambling on areas. We're seeing areas that are growing in value, that are seeing affordability go up, that have an undersupply of property, that don't have a huge amount of property being delivered into them, and for various reasons. So with us, you'll always be consistent in your investments, but there's always be someone that makes more money than you, and this is always the struggle certainly with new clients, is that they'll say, well, my friend Bob has made huge amounts of money in the property market, and he's done it in this area, so I'm going to look at this area. Now, that area may or may not be the best place to invest. It may be that Bob has a great strategy, has found the perfect area, and is investing in that. That may well be the case. But 99% of the time, it is that the property market's just been growing. So, even if you threw a dart at the map, 10 years ago, you would have made between 3 and 4% per annum. That's compounded. So if you invested 30% on your mortgage, you're talking about 9 to 12% per year if you picked anywhere. So obviously people think they're being very, very successful when actually they could perform better. It also, sometimes what you find is just because someone's done well, it doesn't mean that their strategy was correct. They got lucky with their purchase. I think we see this a lot with like cryptocurrency. People invested early on. But when you actually ask them the strategy behind the investment and try and understand it, it's not forthcoming. We see this a lot with property. Property's just been consistently going up, so people think they have a strategy when they don't. So again, this is one of the issues that we have, certainly with new clients that don't understand the work that we're doing to be able to isolate these areas. The other part of that is you have to be a little bit more brave to invest in an area that's not immediately around your property, because there's a feeling with a lot of people that if it's nearby, I've got my eye on it. It's a lot of money for me. This, I want to be able to drive past it. Whereas in reality, it just might not. You might not be living in the best area for investment, and in actual fact, most of us aren't, because if we're looking at investment as a place that's getting better, a lot of people who are investors have decided for their family home to be in the nicest area they can possibly be in. That may mean that it's already grown the most it can, because it's such a nice area that there is no more growth in it. It's only going to grow at what people's salaries grow at, which might not be as good as other parts of the UK. So when we're looking at new areas of the UK to invest, and the best areas to invest, we've looked at our fundamentals, so we need an undersupply, obviously. We don't want to be looking at a place that's oversupplied with property. Thankfully in the UK, that's virtually everywhere. So we're looking for an undersupply, and we're looking at salary growth, so a growth in salary. Now, the easiest way to get that, and the easiest way to get future growth, and this has always been the same strategy since Genesis, is that what we look for fiscal policy. So that the easiest way for you to make money out of property is to look at, well, what's done well previously, what's been doing well for the last few years, but is getting better. So it's already done well. We're not trying to second guess anything. It's already performing quite well, but it's about to really explode. And for that, we want to look at fiscal policy. Things like, one is obviously university investments and cities being able to retain their students, because if you're retaining students, some cities retain 50% of their students. If you're doing that, these people go into good jobs it means there's good companies in the city. It means that these people are going to earn good money, and they're going to rent nice properties while they save up for the house, or they might just rent full time. So retaining students is hugely important. Any government of the UK knows that. They spend huge amounts of resource trying to have the best universities and retaining them, because then you get the best jobs, and then that generates more GDV within a city. The more GDV, the wealthier people get, the better jobs there are, the more house prices go up, people are bidding on properties. So this is a really important factor. But that's, so we're looking at cities that may or may not have that. We also are looking then at transport links. I mean, if you were to pick if you had one strategy and only one strategy to make money out of property, your best strategy would be picking somewhere where they're about to open up a new tram stop or a new rail station, a new HS2. I mean, we've got the HS2 coming to England, and some people are still think that it's not necessarily the most important investment spot. I mean, it's really it's such an important factor that anybody that has the opportunity to buy one of these areas and doesn't will look back in 10 years time, 15 years time, and think, why did I not do that? The difficulty with a lot of these areas, sometimes when it's so obvious, as Brits primarily we see it. I mean, international investors seem to be better at this, but British people, we tend to look at something and think that it's almost too good to be true, or the house prices have grown so much already that it's already been maximized. Well, don't just assume that. Go and look, because a lot of these places that has not happened yet. You look at Birmingham, you look at Old Oak Common in London. These areas are hugely important, and they're on the HS2 stop, and their prices are still going up and will continue to go up for aggressively for the next 5 years. And you can tell that by the affordabilities there. People can actually afford for the prices to go up. Now, just because you think that they can't doesn't mean that they can't, and this is where data is hugely important. So to be more specific, we look at transport links, we look at investment areas. Is there new jobs being created, and a lot of jobs being created in specific areas? So with this in mind, there's a few places that you really should be looking at. One is commute to London. Obviously, if you can be commuted to one of the best cities in the world, you're going to do very, very well. Inner city London, a lot of it's been maximised in terms of value, in terms of what people can afford, but there is still areas. We have some developments in the likes of, I mentioned that Old Oak Common, which is where it's going to be the busiest train station in the whole of England, or the whole of Britain, right? One of the busiest train stations in Europe will be in this one area of London, which currently it's being regenerated as we speak, but it's been sort of light industrial before. What this means is we can buy the land, we can buy property there, a lot below the average price of its neighbours, and yet this area is going to be one of the most important spots of London. If you have the money, if you have 650,000 or a couple of 100,000 investment, whereby we can leverage that with a mortgage, that's a really important spot for you to look at. Come and speak to us about there. Other areas which are a bit more, maybe slightly easier in terms of from an investment perspective, are the likes of Ashford. So in Ashford's a part of the country that isn't on a lot of people's radar. Really, really should be. It's obviously a beautiful part of the world. It's Kent. People go there on their holidays. It's such a nice area. It's green. And and it's next to the coast. It's close to the coast. You can jump on a train and be in Paris, Brussels, and Amsterdam in a couple of hours. But the really important part of this area is that there is the train line has been improved dramatically. So now, rather than it taking an hour and a half that it did to do before to get from Ashford to London, you can now get to St Pancras in 36 minutes. You're in central London, and probably at your office within the hour, which anything within an hour for London transport is huge. Now you can buy, in this area, this Ashford area, we've got brand new, just completing, we've got a completing and off plan, but you're buying for 300,000 for a 2-bed, and yet you're bringing London wages there. Because of all this stuff that's been going on, this was all planned out from 2006. The government knew there was going to be a huge number of people moving there. And because of that, they've given all this planning permission for a lot of property there, but nowhere near enough to supply the demand. To give you an idea about how good this area is, there is only 0.3% available property at any one time, vacant property. A city's performing very well if they have around 1%, 1.5% of their properties are vacant at any one time. As you know, people leave and rent out, and so if 1% is available, it means 99% are not available. If your property's rented for 99% of the lifetime of you owning it, you'll be incredibly happy. So it's a very, very good sign. Ashford is 0.3 because there's so many people moving here. There's also new film studios, huge amounts going on there. That film studio is bringing 3,000 jobs, new cafes, restaurants, so much going on there, and it's also easy commuter for drive. The other beauty is that the train is joining onto the fast train that goes into London is then joining onto the HS2 as well. So you'll be able to not only get into London very quickly, but then you'll be able to get from your home to Birmingham in an hour and a half, somewhere like that. So again, hugely important strategic location for your investment. If you're looking for something London commuter, you have to be looking there. A lot of other London commuters have been maximised. There's still some growth. Reading, we've got a new development coming on there. There's still growth in these areas, but not in comparison. If you were to look at for every pound invested in Ashford compared to a pound invested in somewhere else, London commuter, Cambridge, Oxford, what have you, you'd make an awful lot more with Ashford. And you can also have a property that does everything that modern tenants want. What do they want? They want outdoor spaces. They don't want to be cooped up. People have been locked down during the pandemic in a 350 square foot 1-bed in central London. What we need to do is we need to make sure that when we're looking at property, we're bearing this in mind. People are looking for outdoor spaces. They are looking for amenities, business centres, gyms, cinema rooms, roof gardens or outdoor gardens, some grassland around. So look, that's the sort of thing you should be looking for, and places like Ashford can be affordable with that type of investment. You're probably looking at 80 to 100,000 pounds for a 2-bed, in around there, a little bit less for a 1-bed. Other locations you really need to be considering are Birmingham, obviously, again the HS2 line, but not just the HS2 line in Birmingham. You want to be looking at the connectivity. So the HS2 is hugely important, but before the HS2 arrives, the local government have to build a lot of transport links, so tram links, metro links, new rail stations, because when you're bringing a HS2 to a city or something like that, it's so big for the city that you want to make sure that it is, you're empowering the whole city. So to do that, they need connectivity to the 2 HS2 stations in Birmingham. Now, both these HS2 stations and all of these transport links, again, we go back to what I said at the start, which is that's the easiest way to, there's no guarantees, but it's the easiest way to show historical growth. So it's the easiest way to get growth in your property is to find locations around these new tram stops, and there's hundreds of them through Birmingham. So obviously, if you can afford it, you want to be looking at Digbeth, whereby, again, 2 beds around 300,000, 1 bed's around 200,000. But what you're getting for that is you're getting a location where you can walk not only to the HS2 station, but also to the whole new Smithfield market plan, all the investment that's going into Digbeth. And still, at the moment, and it's probably the last couple of years, is Digbeth still cheaper than a lot of the other main central Birmingham locations. So again, Digbeth, hugely important. Other areas, Jewellery Quarter, very, very nice for a bit more, to see the historical growth. But at the moment, I'd really be interested in buying into Digbeth while price per square foot's lower or lower than it should be. People from Birmingham will remember Digbeth again as a really quite a light industrial area, much like we saw in Manchester with the Northern Quarter spinning field. It's only a matter of time before that is become spikes in property even further, and is maximised. So anybody that's looking at areas saying, well, I don't want to buy it because it's more expensive than last year, you're looking at the wrong strategy. You're trying to buy property that doesn't grow in value. You have to be buying in the right area. It's more likely than not going to be more expensive than it was last year, the year before that, because it's going to continue on. What you need to be looking at is, can people afford for the growth to continue? And with Digbeth, absolutely yes, they can, and it absolutely will do. So Digbeth's a really important one. You might have seen we finished off a lot of our third project in Sheldon, part of Birmingham, again, because we were able to buy in so cheap, and there's a new transport link coming all the way through Sheldon. It was just a perfect investment. I think every one of our investors, a lot of people will be on this seminar, had an amazing result out of that, and so, but again, those sorts of areas very, very important for investment. Once we're outside of Birmingham and Ashford or the London commuter, naturally, questions are asked about the likes of Manchester. For me at the moment, Manchester's really, Manchester's not got a huge amount of further sort of transport links going into them. They built the tram stops, and so but as a city, it's incredible. Personally, or certainly as a company's strategy, we have the luxury products in Manchester, and luxury products will always perform well. There's a huge amount of wealth in Manchester. There's a lot of people constantly moving to the city centre. If you look at that inner ring road of Manchester, it's almost completely maximised. There's no more land to build on, which means that property prices are just going to continue to go up. The luxury sector in Manchester, there's been a lot of delivery into it. So there's been a lot of new projects being delivered and about to be delivered in the luxury sector. So for the next year or two, my focus and the company's focus will be predominantly out of the luxury sector and looking a little bit more at the likes of the almost tier 2, so the sort of more reasonably mid-range pricing properties, maybe 270 to 300 2 beds, slightly cheaper 1 beds. That's a part of the Manchester market that's not being looked after enough, and so that's really should be a really good focus area for you as an investor. Other places, Leeds doing very, very well. Unfortunately, there's not an awful lot of great projects in Leeds, so we're still looking for great projects in the city. And similar for Liverpool, there is some reasonable projects, but just not the sort of stuff that is going to compete really on the same level as the likes of Birmingham, Ashford or Manchester. But we do have some projects. We've got the best project probably in the northwest, the most beautiful project, Liverpool waterfront. For if you want 1,000 square foot luxury hotel quality finish project on the waterfront, that is the one. That's the one you need to be buying. You can buy anything on the waterfront of Liverpool and it will increase in value. But the really important stuff to look for is these are 1,000 square foot 2 beds. nobody's going to build anything like that again because it's too expensive to build. There's not enough profit in it. You'd be better buying, you'd be better building 600 square foot, 650 square foot, 2 beds, squeezing people in. People will buy them. But if you really, really want to retain your value, buy something like that. That Liverpool waterfront, it's called Tobacco Warehouse. Have a look at it. Other than that, people are looking at, there's various parts of the UK which are still interesting, you'll still make money on, but these are the cities that are hugely important, and with a particular emphasis on looking at Ashford and Birmingham. Anything that you're buying this year, if you're open to investment across the UK, these are the areas that you should be looking at. Okay, so hopefully that covers most of what we wanted to go through in terms of the effect of the pandemic, the effect of Brexit, for instance. Brexit's had less of an impact now because it's been ironed out. There's, most of it's been, we've gone through most of it. So the details of it, there's minor, obviously. It doesn't mean that anybody's happy with it, but it's not really going to affect in a dramatic way. UK property, we've seen that property prices actually grew through that. Property prices grew through the pandemic as well because UK is seen as a safe place for your money. So, if you have cash, you're either investing in your bank account, keeping it in there and losing money on it, or you're putting it into stocks, bonds, or property. So once you've got enough for a rainy day saved in your bank, the rest of it needs to be going into one of these places. And most of the world, if not the whole of the world, sees UK as a very, very one of the safest places to put their money. So during the pandemic, although maybe if you live in the UK, you wouldn't have thought this. Why invest during a pandemic? But if you have money and it's in your bank account, you've got inflation. You are investing. You're just investing in the wrong things. So again, most people are seeing UK as this is a really safe spot for my money. So we saw growth. We're expecting that to continue. If you look at supply and demand, because a lot of developers weren't able to start new construction projects during the pandemic. We've got it's even more difficult in terms of supply. So is today the best time to invest in property? No, the best time was 10 years ago or 1 year ago even. But if you haven't and you have that cash, you need to be investing today. You need to be looking at some of these markets. With property investment, don't try and time the market. It's time in the market rather than trying to time the market correctly. If you look historically, it goes up. So long as you're doing the right things, looking at the right markets that can grow in value, looking at historical growth, you're double checking with us things like interbank exchange rate to make sure that mortgages are being lent, that there's still lending going on. Then, and affordability, obviously, you're going to see property prices increase. So, look, let's go on to the questions now, and I can go through a bit of Q&A with you.